Navigating VOO, Insights into Portfolio Allocation, Risk Management, and Beyond. Welcome back, investors. Today, we're diving deep into the world of Vanguard S&P 500 ETF, VOO, and exploring how it fits within different asset allocation models for various investor profiles. But that's not all. We'll also uncover the primary factors influencing VOO's decision-making process, analyze its potential benefits and drawbacks compared to actively managed U.S. large-cap funds, and reveal the key considerations for choosing VOO over competitors. Plus, we'll provide insights into the potential impact of macroeconomic factors on VOO's performance and discuss alternative investment strategies to hedge or mitigate risks associated with this popular ETF. So, buckle up and get ready for a comprehensive journey through the world of VOO. Question 1. How does VOO fit within different asset allocation models for various investor profiles? Before diving into its role within asset allocation models, let's first understand what VOO is all about. VOO is an ETF offered by Vanguard that seeks to track the performance of the Standard & Poor's 500 index, one of the most widely followed benchmarks for the U.S. equity market. The S&P 500 index comprises 500 of the largest publicly traded companies in the United States, spanning various sectors and industries. By investing in VOO, investors gain exposure to a diversified portfolio of blue-chip companies, representing a significant portion of the U.S. stock market. Asset allocation is the process of spreading investments across different asset classes such as stocks, bonds, and cash, with the goal of optimizing risk-adjusted returns. The optimal asset allocation varies from investor to investor based on factors such as risk tolerance, investment objectives, time horizon, and financial goals. Let's explore how VOO can be incorporated into different asset allocation models for investors with varying profiles. 1. Conservative investors. For conservative investors with a low-risk tolerance and a primary goal of capital preservation, VOO can still play a role within a diversified portfolio. While equities inherently carry more risk than bonds or cash, the broad diversification offered by VOO across 500 large-cap U.S. companies can mitigate some of that risk. Conservative investors may consider allocating a smaller portion of their portfolio to VOO, perhaps alongside high-quality bonds or fixed-income securities, to achieve a balance between growth potential and downside protection. 2. Moderate investors. Moderate investors typically have a balanced approach to risk and return, aiming for steady capital appreciation while also prioritizing capital preservation to some extent. For these investors, VOO can serve as a core holding within their equity allocation. By allocating a significant portion of their portfolio to VOO, moderate investors can gain exposure to the potential long-term growth of the U.S. stock market while diversifying away company-specific risk. To further diversify their portfolio, moderate investors may also consider incorporating other asset classes such as international equities, bonds, and alternative investments. 3. Aggressive investors. Aggressive investors are willing to take on higher levels of risk in pursuit of potentially higher returns over the long term. For these investors, VOO can be a cornerstone of their equity allocation, providing broad exposure to the U.S. stock market's growth potential. Aggressive investors may choose to allocate a substantial portion of their portfolio to VOO, complementing it with other high-risk, high-reward investments such as small-cap stocks, emerging market equities, and sector-specific ETFs. While VOO offers diversification benefits, aggressive investors should be mindful of market volatility and be prepared to weather short-term fluctuations in pursuit of their long-term investment goals. 4. Retirement investors. Retirement investors have a long-term investment horizon and are primarily focused on building wealth for retirement. For these investors, VOO can be an excellent choice as a core holding within their retirement portfolio. By investing in VOO, retirement investors can benefit from the compounding growth of the U.S. stock market over time, potentially bolstering their retirement savings. Additionally, VOO's low expense ratio makes it cost-effective to hold over the long term, minimizing the impact of fees on investment returns. Retirement investors may consider complementing their VOO holdings with other asset classes such as bonds, real estate investment trusts, REITs, and dividend-paying stocks to further diversify their portfolio and manage risk. Vanguard S&P 500 ETF, VOO, can play a vital role within diversified asset allocation models for investors across different risk profiles and investment horizons. Whether conservative, moderate, aggressive, or retirement investors, VOO offers broad exposure to the U.S. equity market's growth potential while providing diversification benefits. By incorporating VOO into their portfolios alongside other asset classes, investors can effectively manage risk, optimize returns, and work towards achieving their long-term financial goals. However, it's essential for investors to conduct thorough research, assess their risk tolerance, and consult with a financial advisor before making any investment decisions. Question 2. What are the primary factors influencing the decision-making process of VOO for including or excluding stocks from the S&P 500 index? The Standard & Poor's 500 index, often referred to as the S&P 500, stands as a benchmark for the broader U.S. equity market, comprising 500 of the largest publicly traded companies. Vanguard S&P 500 ETF, VOO, seeks to track the performance of this illustrious index, providing investors with exposure to a diversified portfolio of blue-chip stocks. However, behind the scenes, there's a meticulous decision-making process governing which stocks make it into this prestigious index, and subsequently, into VOO. In this in-depth exploration, we unravel the primary factors influencing the inclusion or exclusion of stocks from the S&P 500 index, shedding light on VOO's underlying decision-making framework. 1. Market capitalization. One of the fundamental criteria for inclusion in the S&P 500 index is market capitalization. The index aims to represent a significant portion of the U.S. stock market, and as such, it typically includes companies with large market capitalizations. The exact threshold for inclusion may vary, but companies must generally have a market capitalization of several $billion to be considered for inclusion. Conversely, companies that experience significant declines in market capitalization may be at risk of being removed from the index. 2. Liquidity. Liquidity plays a crucial role in the decision-making process for including or excluding stocks from the S&P 500 index. Given the index's significance as a benchmark for the broader market, it's essential that the included stocks are highly liquid, meaning there is ample trading activity and tight bid-ask spreads. Stocks with low liquidity may not accurately reflect the true performance of the market and can introduce unwanted volatility into the index. Therefore, companies with sufficient trading volume and liquidity are favored for inclusion in the index. 3. Financial viability. Companies included in the S&P 500 index are expected to demonstrate financial viability and stability. This includes factors such as profitability, revenue growth, and balance sheet strength. Companies with a history of consistent earnings and revenue growth are more likely to be included in the index, as they are perceived to be less risky and more representative of the overall market. Conversely, companies experiencing financial distress or significant declines in profitability may be at risk of being excluded from the index. 4. Sector representation. The S&P 500 index aims to provide broad representation across different sectors of the economy. As such, the composition of the index is carefully balanced to ensure adequate representation from sectors such as technology, healthcare, finance, consumer discretionary, and industrials, among others. The index seeks to reflect the overall composition of the U.S. economy, and companies from sectors with significant market capitalization and economic importance are more likely to be included in the index. 5. Corporate governance. Corporate governance practices also play a role in the decision-making process for inclusion in the S&P 500 index. Companies with strong corporate governance practices, including transparent disclosure, independent boards of directors, and shareholder-friendly policies, are viewed more favorably. Conversely, companies with poor corporate governance practices, such as conflicts of interest, excessive executive compensation, or inadequate shareholder rights, may be excluded from the index or face scrutiny from index providers. 6. Growth potential. While the S&P 500 index is primarily focused on representing the current state of the U.S. stock market, consideration is also given to the growth potential of included companies. Companies that demonstrate strong growth prospects, innovation, and adaptability to changing market conditions are more likely to be included in the index, as they are perceived to contribute to the long-term growth and vitality of the U.S. economy. Conversely, companies with stagnant growth or limited expansion opportunities may be at risk of being excluded from the index. The decision-making process for including or excluding stocks from the S&P 500 index is a multifaceted endeavor, guided by several key factors. Market capitalization, liquidity, financial viability, sector representation, corporate governance, and growth potential all play crucial roles in shaping the composition of the index. As the underlying benchmark for VOO, understanding these factors provides investors with insights into the selection criteria governing the ETF's portfolio. By delving into the intricacies of the decision-making process, investors can gain a deeper appreciation for the construction and composition of VOO, empowering them to make informed investment decisions aligned with their financial goals and risk preferences. Question 3. What are the potential benefits and drawbacks of using VOO as a core holding, compared to actively managed U.S. large-cap funds? In the world of investing, the choice between passive and active management has long been a subject of debate among investors and financial professionals. Vanguard S&P 500 ETF, VOO, represents the epitome of passive investing, seeking to replicate the performance of the Standard & Poor's 500 index, while actively managed U.S. large-cap funds employ strategies aimed at outperforming the market through active stock selection and timing. In this comprehensive analysis, we explore the potential benefits and drawbacks of using VOO as a core holding compared to actively managed U.S. large-cap funds, offering insights to help investors make informed decisions about their investment strategies. Benefits of using VOO as a core holding. 1. Cost-effectiveness. One of the most significant advantages of VOO as a core holding is its low cost. As an exchange-traded fund (ETF) with a passive investment strategy, VOO typically has lower expense ratios compared to actively managed funds. These lower costs translate into higher net returns for investors over the long term, as fees and expenses can significantly erode investment returns, especially over extended periods. 2. Broad market exposure. VOO provides investors with broad exposure to the U.S. large-cap equity market by tracking the performance of the S&P 500 index, which comprises 500 of the largest publicly traded companies in the United States. This broad market exposure offers diversification benefits, allowing investors to spread their investment across a wide range of blue-chip stocks and sectors, thereby reducing company-specific risk. 3. Transparency. Passive ETFs like VOO offer investors transparency in terms of holdings and investment strategy. Since VOO seeks to replicate the performance of the S&P 500 index, investors can easily access information about the index constituents and their respective weights. This transparency allows investors to make informed decisions about their investment allocations and understand the underlying risks associated with the ETF. 4. Tax efficiency. Passive ETFs, like VOO, tend to be more tax efficient compared to actively managed funds. Because of their low turnover and buy-and-hold strategy, ETFs incur fewer capital gains distributions, resulting in lower tax liabilities for investors. This tax efficiency can be particularly advantageous for investors holding VOO in taxable accounts, as it helps to minimize the drag on after-tax returns. 5. Long-term performance. While past performance is not indicative of future results, historical data has shown that passive index funds like VOO have delivered competitive long-term performance relative to actively managed funds. By tracking the performance of the S&P 500 index, VOO captures the overall growth of the U.S. equity market, providing investors with exposure to the potential wealth-building opportunities offered by large-cap U.S. stocks over time. Drawbacks of using VOO as a core holding. 1. Lack of active management. One of the primary drawbacks of using VOO as a core holding is the lack of active management. Unlike actively managed funds, which employ portfolio managers and research teams to select and manage investments actively, VOO simply seeks to replicate the performance of the S&P 500 index. While this passive approach offers cost-effectiveness and broad market exposure, it may result in missed opportunities to outperform the market through active stock selection and timing. 2. No potential for outperformance. Since VOO aims to replicate the performance of the S&P 500 index, it does not have the potential to outperform the market. While this may not be a concern for investors seeking market-matching returns, those who are actively seeking to beat the market may find VOO's passive approach limiting. Actively managed funds have the potential to outperform the market through skillful stock selection, sector rotation, and market timing, albeit with higher costs and risks. 3. Limited flexibility. Passive ETFs, like VOO, have limited flexibility compared to actively managed funds. The fund's holdings are dictated by the composition of the underlying index, with little room for deviation or customization. While this passive approach offers simplicity and ease of use, it may not be suitable for investors with specific investment objectives or preferences, such as sector concentration, risk management, or ESG, environmental, social, and governance considerations. 4. Tracking error. Despite its aim to replicate the performance of the S&P 500 index, VOO may experience tracking error, which is the divergence between the ETF's returns and the index's returns. Factors such as transaction costs, dividend reinvestment, and portfolio rebalancing can contribute to tracking error over time. While tracking error is generally minimal for well-managed ETFs like VOO, it can still impact investors' returns, especially over extended periods. 5. Market volatility. Passive ETFs like VOO are susceptible to market volatility, as they track the performance of the underlying index. During periods of market turmoil or extreme volatility, VOO may experience significant price fluctuations, mirroring the ups and downs of the broader market. While this volatility is a natural part of investing, it may cause short-term fluctuations in the value of investors' holdings and test their risk tolerance and patience. The choice between using VOO as a core holding and investing in actively managed U.S. large-cap funds ultimately depends on investors' individual preferences, objectives, and risk tolerance. VOO offers cost-effectiveness, broad market exposure, transparency, tax efficiency, and competitive long-term performance, making it an attractive option for investors seeking market-matching returns with low fees. However, VOO's passive approach may limit its potential for outperformance, flexibility, and customization compared to actively managed funds. Investors should carefully consider their investment goals, time horizon, and risk appetite before deciding whether to incorporate VOO into their investment portfolios or opt for actively managed alternatives. Consulting with a financial advisor can provide valuable insights and guidance tailored to investors' specific needs and circumstances, helping them navigate the complex landscape of investment choices effectively. Question 4. What are the key considerations for choosing VOO over competitors? In the vast landscape of exchange-traded funds (ETFs), Vanguard S&P 500 ETF (VOO) stands out as a premier option for investors seeking exposure to the U.S. large-cap equity market. However, amidst the myriad of ETFs available, investors are often faced with the daunting task of choosing the right one to meet their investment objectives. In this comprehensive guide, we explore the key considerations for choosing VOO over its competitors, offering insights to help investors make informed decisions about their investment strategies. 1. Cost-effectiveness. One of the primary considerations for choosing VOO over competitors is cost-effectiveness. As a flagship offering from Vanguard, VOO boasts one of the lowest expense ratios in the industry, making it an attractive option for cost-conscious investors. With an expense ratio typically below 0.05%, VOO offers investors exposure to the S&P 500 index at a fraction of the cost charged by many competing ETFs. Lower expenses translate into higher net returns for investors over the long term, making VOO a compelling choice for those looking to maximize their investment dollars. 2. Tracking accuracy. Another key consideration for choosing VOO over competitors is its ability to accurately track the performance of the S&P 500 index. Vanguard has a strong track record of delivering reliable and consistent tracking performance, ensuring that VOO closely mirrors the returns of its underlying index. This tracking accuracy is crucial for investors seeking to replicate the performance of the broader U.S. equity market without the risk of significant tracking error. By choosing VOO, investors can have confidence in the ETF's ability to faithfully replicate the performance of the S&P 500 index over time. 3. Liquidity and trading volume. Liquidity and trading volume are essential factors to consider when evaluating ETFs, as they can impact the ease and cost of buying and selling shares. VOO enjoys robust liquidity and trading volume, with millions of shares traded on a daily basis on major stock exchanges. This high level of liquidity ensures tight bid-ask spreads and minimal slippage, making it easy for investors to execute trades at fair market prices. Additionally, VOO's ample trading volume provides liquidity support during periods of market volatility, reducing the risk of price distortions and order execution delays. 4. Diversification and sector exposure. VOO offers investors broad exposure to the U.S. large-cap equity market by tracking the performance of the S&P 500 index, which comprises 500 of the largest publicly traded companies in the United States. This diversified portfolio provides investors with exposure to a wide range of sectors and industries, including technology, healthcare, finance, consumer discretionary, and industrials, among others. By choosing VOO, investors gain access to the potential growth and stability offered by blue-chip companies across various sectors of the economy. 5. Tax efficiency. Tax efficiency is an important consideration for investors, especially those holding ETFs in taxable accounts. VOO's structure as an index fund and its low turnover rate contribute to its tax efficiency, resulting in fewer capital gains distributions and lower tax liabilities for investors. Additionally, VOO's low expense ratio helps to minimize the impact of fees on after-tax returns, further enhancing its tax efficiency. By choosing VOO, investors can optimize their after-tax returns and minimize the drag of taxes on their investment performance. 6. Reputation and track record. Vanguard is renowned for its commitment to low-cost investing, investor-friendly practices, and fiduciary responsibility. With decades of experience in managing index funds and ETFs, Vanguard has built a strong reputation for delivering value to investors and putting their interests first. VOO benefits from Vanguard's expertise and track record, providing investors with confidence in the ETF's reliability, transparency, and long-term performance potential. By choosing VOO, investors align themselves with a trusted brand and a proven leader in the investment management industry. Vanguard S&P 500 ETF, VOO, offers investors a compelling option for gaining exposure to the U.S. large-cap equity market. With its low cost, accurate tracking, ample liquidity, broad diversification, tax efficiency, and strong reputation, VOO stands out as a top choice for investors seeking a cost-effective and reliable way to invest in the S&P 500 index. By carefully considering these key factors and comparing VOO to its competitors, investors can make informed decisions about whether VOO aligns with their investment objectives, risk tolerance, and long-term financial goals. Consulting with a financial advisor can provide additional insights and guidance tailored to investors' individual needs and circumstances, helping them navigate the complex landscape of ETF investing effectively. Question 5. How does VOO's portfolio concentration influence its risk profile and potential for outperformance or underperformance compared to the broader market? Vanguard S&P 500 ETF, VOO, is renowned for its simplicity and efficiency in providing investors with exposure to the U.S. large-cap equity market. However, beneath its seemingly straightforward approach lies a portfolio composition that warrants closer examination. VOO's portfolio concentration, or the weighting of its holdings towards certain sectors and individual stocks, plays a significant role in shaping its risk profile and potential for outperformance or underperformance relative to the broader market. In this comprehensive analysis, we delve into how VOO's portfolio concentration influences its risk profile and performance, offering insights to help investors navigate the nuances of investing in this popular ETF. 1. Understanding VOO's portfolio composition. Before exploring its risk profile and performance, let's first understand VOO's portfolio composition. As an ETF that seeks to track the performance of the Standard & Poor's 500 index, VOO invests in the same 500 largest publicly traded companies in the United States that make up the index. However, the weightings of these holdings within VOO's portfolio may differ slightly from the index due to factors such as corporate actions, market fluctuations, and rebalancing. 2. Impact of sector concentration on risk profile. One of the key factors influencing VOO's risk profile is its sector concentration. While the S&P 500 index is diversified across various sectors of the economy, certain sectors may have a more significant weighting within VOO's portfolio than others. For example, technology, healthcare, and finance sectors often have substantial weightings within the S&P 500 index, leading to a similar concentration within VOO. As a result, VOO's performance may be more sensitive to movements in these sectors, increasing its sector-specific risk compared to a more diversified ETF. 3. Influence of individual stock weightings. In addition to sector concentration, VOO's risk profile is also influenced by the weightings of individual stocks within its portfolio. While the S&P 500 index is market cap weighted, meaning that larger companies have a higher weighting within the index, individual stock weightings may still vary within VOO's portfolio. Stocks with higher weightings may have a more significant impact on VOO's performance, leading to potential concentration risk if these stocks underperform relative to the broader market. 4. Potential for outperformance. Despite its portfolio concentration, VOO has the potential to outperform the broader market under certain conditions. If the sectors and individual stocks with higher weightings within VOO's portfolio outperform the rest of the market, VOO may deliver above-average returns relative to its benchmark index. Additionally, VOO's low expense ratio and passive investment strategy may contribute to its ability to outperform actively managed funds over the long term, especially in periods of market efficiency. 5. Potential for underperformance. Conversely, VOO also has the potential to underperform the broader market, particularly if the sectors and individual stocks with higher weightings within its portfolio lag behind the rest of the market. Sector-specific challenges, such as regulatory changes, economic downturns, or industry disruptions, may adversely affect VOO's performance if its portfolio is heavily concentrated in those sectors. Additionally, VOO's passive investment strategy means that it does not have the flexibility to actively manage its portfolio to mitigate underperformance during market downturns or adverse events. 6. Mitigating risk through diversification. While VOO's portfolio concentration may introduce certain risks, investors can mitigate these risks through diversification. By combining VOO with other ETFs or asset classes that have low correlation to the U.S. large-cap equity market, investors can reduce their exposure to sector-specific and individual stock risks. Additionally, investors can consider allocating a portion of their portfolio to actively managed funds or alternative strategies that seek to capitalize on market inefficiencies and exploit opportunities for outperformance. VOO's portfolio concentration plays a significant role in shaping its risk profile and potential for outperformance or underperformance relative to the broader market. While sector concentration and individual stock weightings may introduce certain risks, VOO offers investors a cost-effective and efficient way to gain exposure to the U.S. large-cap equity market. By understanding the nuances of VOO's portfolio composition and risk factors, investors can make informed decisions about whether VOO aligns with their investment objectives, risk tolerance, and long-term financial goals. Consulting with a financial advisor can provide additional insights and guidance tailored to investors' individual needs and circumstances, helping them navigate the complexities of investing in VOO effectively. Question 6. What alternative investment strategies or asset classes could be used to hedge or mitigate the risks associated with VOO? Vanguard S&P 500 ETF, VOO, offers investors exposure to the U.S. large-cap equity market, but like any investment, it comes with its own set of risks. While VOO provides diversification benefits by investing in 500 of the largest publicly traded companies in the United States, investors may seek additional strategies to hedge or mitigate specific risks associated with this ETF. In this comprehensive analysis, we explore alternative investment strategies and asset classes that investors can consider to complement their VOO holdings and enhance their overall portfolio resilience. 1. Fixed income investments. Fixed income investments, such as bonds and treasury securities, offer investors a way to diversify their portfolio and reduce overall risk exposure. Bonds provide income through regular interest payments and can serve as a hedge against equity market volatility. Treasury securities, in particular, are considered one of the safest investments, as they are backed by the full faith and credit of the U.S. government. By allocating a portion of their portfolio to fixed income investments, investors can cushion the impact of market downturns and stabilize their overall investment returns. 2. International equities. Investing in international equities can provide diversification benefits and reduce reliance on the U.S. equity market. International markets may offer opportunities for growth and capital appreciation that are uncorrelated with the U.S. market, helping to mitigate concentration risk associated with VOO. Investors can gain exposure to international equities through region-specific ETFs, global ETFs, or actively managed international funds. By diversifying across different geographic regions and economies, investors can reduce their exposure to country-specific risks and potentially enhance their portfolio returns. 3. Real estate investment trusts. REITs Real Estate Investment Trusts, REITs, offer investors exposure to the real estate market without the need to directly own physical properties. REITs invest in a variety of real estate assets, including residential, commercial, and industrial properties, and generate income through rental payments and property appreciation. Investing in REITs can provide diversification benefits and act as a hedge against inflation, as real estate tends to perform well in inflationary environments. Additionally, REITs often have low correlation with the stock market, making them an attractive option for diversifying a portfolio that includes VOO. 4. Commodities. Commodities, such as gold, silver, oil, and agricultural products, offer investors a way to hedge against inflation and currency devaluation. Unlike traditional financial assets, commodities have intrinsic value derived from their use in industrial production, consumption, or investment purposes. Investing in commodities can provide diversification benefits and serve as a hedge against geopolitical risks and economic uncertainties. Investors can gain exposure to commodities through commodity ETFs, commodity futures contracts, or physically backed commodity funds. By including commodities in their portfolio alongside VOO, investors can enhance their portfolio's risk-adjusted returns and reduce overall volatility. 5. Alternative investments. Alternative investments, such as hedge funds, private equity, and venture capital, offer investors access to non-traditional asset classes and investment strategies. Alternative investments often have low correlation with the broader stock and bond markets, making them effective diversifiers in a portfolio that includes VOO. While alternative investments may carry higher fees and liquidity constraints compared to traditional assets, they can provide unique sources of return and downside protection during market downturns. Investors should carefully evaluate the risks and benefits of alternative investments and consider their suitability within the context of their overall investment objectives and risk tolerance. 6. Cash and cash equivalents. Cash and cash equivalents, such as money market funds and short-term treasury securities, offer investors safety and liquidity during periods of market volatility. While cash investments may have lower returns compared to equities and fixed-income securities, they provide a stable source of capital preservation and purchasing power protection. Investors can use cash and cash equivalents to maintain liquidity in their portfolio and take advantage of investment opportunities as they arise. By holding a portion of their portfolio in cash, investors can reduce overall portfolio volatility and maintain flexibility in their investment decisions. Investors can employ a variety of alternative investment strategies and asset classes to hedge or mitigate the risks associated with VOO. Fixed income investments, international equities, real estate investment trusts, REITs, commodities, alternative investments, and cash equivalents offer diversification benefits and downside protection in a portfolio that includes VOO. By carefully considering these alternative options and their respective risk-return profiles, investors can construct a well-diversified portfolio that is resilient to market fluctuations and aligned with their investment objectives and risk tolerance. Consulting with a financial advisor can provide valuable insights and guidance tailored to investors' individual needs and circumstances, helping them navigate the complexities of portfolio construction and risk management effectively. Question 7. What alternative investment strategies or asset classes could be used to hedge or mitigate the risks associated with VOO? Vanguard S&P 500 ETF, VOO, offers investors exposure to the U.S. large-cap equity market, providing a convenient and cost-effective way to participate in the growth potential of top American companies. However, like any investment, VOO carries inherent risks, including market volatility and sector-specific challenges. To build a well-rounded and resilient portfolio, investors may consider diversifying beyond VOO by incorporating alternative investment strategies and asset classes. In this comprehensive guide, we explore various alternative investment options that can help hedge risks associated with VOO and enhance portfolio stability. 1. Fixed income securities. Fixed income securities, such as bonds and treasury securities, serve as a cornerstone of diversified portfolios by providing income and stability. Bonds offer predictable interest payments and return of principal at maturity, making them ideal for capital preservation and income generation. Treasury securities, in particular, are considered low-risk investments as they are backed by the full faith and credit of the U.S. government. By allocating a portion of their portfolio to fixed income securities, investors can mitigate the volatility of VOO and cushion against potential downturns in the equity market. 2. Real estate investment trusts. REITs. Real estate investment trusts, REITs, offer investors exposure to the real estate market without the need to directly own physical properties. REITs invest in a variety of real estate assets, including residential, commercial, and industrial properties, and generate income through rental payments and property appreciation. Investing in REITs can diversify a portfolio heavily weighted towards equities like VOO, as real estate often exhibits low correlation with the stock market. Additionally, REITs can serve as an inflation hedge and provide steady income, making them attractive for investors seeking diversification and income generation. 3. International equities. Investing in international equities provides investors with exposure to global economic growth and diversification away from the U.S. market. International markets may offer opportunities for capital appreciation that are uncorrelated with domestic equities, helping to mitigate concentration risk associated with VOO. Investors can gain exposure to international equities through region-specific ETFs, global ETFs, or actively managed international funds. By diversifying across different geographic regions and economies, investors can reduce their exposure to country-specific risks and enhance portfolio resilience. 4. Commodities. Commodities, such as gold, silver, oil, and agricultural products, offer investors a way to hedge against inflation and currency devaluation. Unlike traditional financial assets, commodities have intrinsic value derived from their use in industrial production, consumption, or investment purposes. Investing in commodities can diversify a portfolio heavily weighted towards equities like VOO, as commodities often exhibit low correlation with the stock market. Additionally, commodities can serve as a hedge against geopolitical risks and provide diversification benefits during periods of market volatility. 5. Alternative investments. Alternative investments, such as hedge funds, private equity, and venture capital, offer investors access to non-traditional asset classes and investment strategies. Alternative investments often have low correlation with the broader stock and bond markets, making them effective diversifiers in a portfolio that includes VOO. While alternative investments may carry higher fees and liquidity constraints compared to traditional assets, they can provide unique sources of return and downside protection during market downturns. Investors should carefully evaluate the risks and benefits of alternative investments and consider their suitability within the context of their overall investment objectives and risk tolerance. 6. Cash and cash equivalents. Cash and cash equivalents, such as money market funds and short-term treasury securities, offer investors safety and liquidity during periods of market volatility. While cash investments may have lower returns compared to equities and fixed-income securities, they provide a stable source of capital preservation and purchasing power protection. By allocating a portion of their portfolio to cash and cash equivalents, investors can reduce overall portfolio volatility and maintain flexibility in their investment decisions. Additionally, cash reserves can provide liquidity to take advantage of investment opportunities as they arise. Diversifying beyond VOO by incorporating alternative investment strategies and asset classes can help hedge risks associated with the U.S. large-cap equity market and enhance portfolio stability. Fixed income securities, real estate investment trusts, REITs, international equities, commodities, alternative investments, and cash equivalents offer diversification benefits, income generation, and downside protection in a portfolio that includes VOO. By carefully considering these alternative options and their respective risk-return profiles, investors can build a well-rounded portfolio that is resilient to market fluctuations and aligned with their investment objectives and risk tolerance. Consulting with a financial advisor can provide valuable insights and guidance tailored to investors' individual needs and circumstances, helping them navigate the complexities of portfolio construction and risk management effectively. And there you have it, folks, a deep dive into the world of VOO, from portfolio allocation to risk management and beyond. Whether you're a seasoned investor looking to fine-tune your portfolio or a newcomer eager to explore the world of ETFs, VOO offers a compelling option for gaining exposure to the U.S. large-cap equity market. But remember, no investment strategy is without risks, and it's essential to conduct thorough research and consult with financial professionals before making any investment decisions. We hope you found this exploration insightful and informative. Until next time, happy investing!